I'm Professor Indra Besekar. Let's look at accounting for leases. We look at 4 aspects: understand what is leasing, understand the criteria of leasing classification as operating and finance leases, understand how to account for various leasing transactions, and then look at different types of leasing transactions. Direct leasing transactions, with some introduction to manufacturing lease transactions and sale and leaseback transactions. What is leasing? It's an agreement between the lessor and lessee in return for a payment or a series of payment, a right to use an asset for an agreed period of time. So it's the right on one side and the payment on the other side that matters here. It's different from a bank and a loan holder, because ultimately it's the loan holder that obtains the asset, but in the meantime is the bank who has the right. The right is dedicated to the mortgagee, but bank has the ownership of the asset. So rather than the right in a loan transaction, we're talking about the ownership, but in leasing we talk about the right. So when we look at leasing transactions can be classified as operating leases and finance leases. And their classification has implications because as to where they reside and influence on financial statements. The central accounting question here is who should record the asset and or the liability in the leasing transaction. The lessor gives up the right to use the asset for a period, but not the legal ownership. Lessee obtains the right to use the asset for a period, but not the legal ownership. So who should record the asset or liability in the leasing transaction depends on who is bearing the risk and enjoying the rewards, which is central to the ownership. So if that goes to the lessee, then we call it the transaction. Then the lessee has the risk and rewards central to the ownership. To find out how to classify these leases as finance and operating leases, we have to look at 4 aspects. Transfer, whether there's an ownership transfer at the end of the lease term. There's an option to purchase the asset by the lessee at a bargain, which is an incentive. That the lease term is a major part of the economic life of the asset, and the present value of minimum lease payments amounts to at least substantially all of the fair value of the lease asset. If all of the above happens, is met, call it finance lease. Otherwise, it's classified as an operating lease. So it's the lessor that bears the risk and rewards centered to ownership in operating lease, and lessee who bears those risk and benefits in a finance lease. So in an operating lease situation, the lessor holds the asset and depreciates over its useful life, and the lessee incurs an expense for the using of the asset for a lease period. So I'm going to play a video. So think about, how do we know a transaction is a lease transaction? What are the 4 test criteria in classifying a lease transaction as operating a finance lease? What are the benchmarks for
Here we're going to go through an example to determine the type of lease based on lease testing criteria here. And we're going to be looking at it from the lessee's perspective here. And it's either going to be recorded as a capital lease here or as an operating lease. And the test criteria that we're going to go through here would be the 4 test criteria that you would use for determining if it's a capital lease here or as an operating lease. So first, the lessee, to record it as a capital lease, the lease must be non-cancelable, and it must meet one or more of the 4 criteria that we're going to look at here. Otherwise, it will be classified as an operating lease. So looking at our lessee's test criteria here, first criteria, is there a transfer of ownership with this lease here? Second criteria, is there a bargain purchase option? And then thirdly, is the lease term greater than 75% of the economic value? And then number 4 here, test would be, is the present value of the minimum lease payments greater than or equal to 90% of the fair value of the leased asset here. Now, if we can answer yes to any one of these criteria here, any one or more of the criteria, it would be classified as a capital lease. And if the answer comes up no for each one of these test criteria, it would be classified here as an operating lease. So first, going over to our lease arrangement that we'd have here, and I'm only going to touch on the items that affect this example. So we have a yearly rental rate here of $12,000 per year, and then the lease term here is for 20 years, and then the estimated economic life here of the leased asset is 30 years. And then we don't have any purchase option or bargain purchase option, so there's none in this example here. And then the fair market value of the leased asset here at the lease start date is $120,000, and then the cost of the asset to the lessor here is $120,000. So the fair market value here, 120,000 equals the cost here of 120,000. And then next would be the incremental borrowing rate here for the lessee, and that's 12% here. And then we're going to determine the present value of the minimum lease payments using that incremental rate here. We're going to determine it to be $100,389. So now let's go up and do our testing here. So first we're going to look at the transfer of ownership here. Well, it's given in this example here that the lease does not transfer any ownership here. So, and then secondly, well, it failed that test, so we go on to our next test here, the bargain purchase option. And we were given here again that there is no bargain purchase option here, so it would have failed that test here. So we go on to our next test here, the lease term greater than 75% of the economic life. So let's go look at how we test that here. So we have an economic life test here. So is the lease term greater than 75% of the economic life? So the lease term in this case was 20 years, economic life here 30 years, so you divide the 30 years here into the 20 years, and you get 66.6% here for the economic life test. So it's less than the 75%. So it failed the test here. It had to be the lease term would have to be greater than 75% here of the economic life. So again, we failed this test here, so we would have to move on to our next test, and that's that's the present value of those minimum lease payments. Are they greater than or equal to 90% here of the fair market value? So the first thing we have, let's go and calculate the present value of those minimum lease payments. So we have the 12% incremental borrowing rate here, and we have 20 years here on the lease. Payments are $12,000. So we discount those back here using the incremental borrowing rate of 12% and then the 20-year lease here. And discounting them back, the present value of those minimum lease payments are $100,389. So the next thing we have to do is we have to compare it to this 90% hurdle rate here of the fair market value. So our fair market value here of the leased asset at the beginning of the lease was $120,000. Our test rate being 90% here, so 90% of the $120,000 gives us $108,000 here. That would be 90% here of the fair market value of that leased asset. Now we would compare that to the present value of those minimum lease payments here of $100,389. And that is our recovery of our investment here. So we're going to determine that this present value is less than 90% here of the fair market value. And that means it's going to fail the test because it has to be greater than. The present value of those minimum lease payments has to either be greater than or equal to 90% here of the fair market value of the leased asset. So first here, we could look at it in these terms where the $100,389, those minimum lease, present value minimum lease payments is less than the $108,000, the 90% here of the fair market value. Or we can look at it here where we have the $100,389 here, the present value of the lease payments, divided by the fair market value here of $120,000, and that would equal 83.7%, which is less than the 90% hurdle rate here for the test, so therefore it fails the test. So we have now not passed any of those four tests here, so that means here we're classified as an operating lease here. So these four tests that we looked at here, the transfer of ownership, this bargain purchase option, the lease term greater than 75% of the economic life, and the present value of the lease payments here has to be greater than 90% of the fair value. These are the four test criteria that you would be using here for the lessee when you're determining if it's a capital lease or an operating lease. And if we can answer yes to any one of these four tests here, any one or more of those four tests, it would be classified as a capital lease here for the lessee. Otherwise, it would be classified here as an operating lease if you fail all of these tests. And again, if the lease fails all of the tests for the lessee, for the criteria for determining whether it's a capital lease here, then it would be again classified here as an operating lease. And for example, here we're going to, both the lessee and the lessee are going to be using this as an operating lease here, but we went through it here from the lessee's perspective.
The questions that we would like to ponder here, you may pause the video here, proceed to the next slide. So let's look at how to account for various leasing transactions. When it is classified as a finance lease, the lessee bears the asset, the lease liability and lease asset is being created. The lease asset is created because of the right to use the asset. So we would record the lease asset and then depreciate the asset over the lease period. If there's a bargain purchase option, there's a possibility that the lessee will hold the asset for its economic life. So therefore, we depreciate the asset over economic life. The lease liability is the obligation. We take the principal on that. We will then record the principal repayment and the interest expense periodically. For the lessor, the lessor will receive the lease repayment, and also the lease repayment is equal to the principal repayment, and the interest expense is equivalent to the interest revenue, which the lessor then earns as lease revenue. The question is, how much is the lease liability? The lease liability is calculated as the present value of minimum lease payments. So the present value of minimum lease payments comprise the lease payments plus guaranteed residual value, which the lessee has guaranteed to pay as a residual value, and any bargain purchase option that lessee is likely to pay. That becomes the lease payments, total lease payment, but because we are looking at the present situation, we take the present value of minimum lease payments. For the lessor would have the fair value of the asset, that's the present value of minimum lease payments, and in addition to that, there's unguaranteed residual value that the lessor can then earn after returning the asset by the lessee plus the initial direct cost. That becomes the lease receivable. So the lease receivable not necessarily match with the lease liability. The lease liability, which is the present value of minimum lease payment, is the minimum lease payment discounted at an interest rate implicit in the lease. For us to find the implicit interest rate, we take the fair value of the asset plus the initial direct cost, and then we take the minimum lease payments plus the unguaranteed residual value. We take the present value of them, and that's the cash inflow, and the fair value and the initial direct cost is like the cash outflow. If you have to sell the asset and recover it, they should be equal to the current cost versus the future income to be earned, and the discount rate is called the implicit interest rate. In the finance lease situation, we record the initial recognition, we debit lease asset and credit lease liability, and then we would depreciate the lease asset. We debit lease depreciation expense, and credit accumulated depreciation. For the lease payment, we credit cash and debit lease liability for the principal repayment and debit interest expense. There could be executory costs that are included in the payment. So those executory costs are not part of the lease payment, and we would record that as credit cash and debit executory expenses. So there's some technical terms of fair value: non-cancelable lease, contingent rent, transfer of ownership, bargain purchase option, lease term, economic life. These are technical terms that are come across in lease accounting. And also guaranteed residual value, unguaranteed residual value, interest rate implicit in the lease. They are terms that we come across in lease accounting. I'll play another video here. We can look at it and watch the video and ask the questions and try to answer questions. What will happen to lease classification from 1st of January 2019 with the introduction of new leasing standard? which industry sector is likely to be most influenced by the revised lease accounting standard? Why would net debt of companies taking leases will increase due to the revised accounting standard? Why would EBITDA, that is earnings before interest, tax, depreciation and amortization, will increase due to revised lease accounting standard?
I'm joined today by Craig Wolford from City Research to discuss the changes of the lease accounting standard on the retail industry sector. Thank you for joining us, Craig. Thank you. Before we get into the broader implications, I'd like to briefly give a rundown of what the changes actually are. From 1 January 2019, there will be a change to the lease accounting standards which will require all companies to bring the value of their commercial lease arrangements, including property leases, onto their balance sheet based on the present value of the lease obligations. This will have the impact of grossing up balance sheets, but it will also impact income statements by replacing the operating lease expense with a depreciation and an interest expense. So therefore, key metrics driven off accounting measures like
And gather our thoughts. You may want to pause the slides here. I will proceed to the next slide. Let's look at different types of leasing transactions. We'll start with the direct lease transaction. On a direct lease transaction, there's a lessee and a lessor, and there could be a finance lease transaction or operating lease transaction. If it is a finance lease transaction, the lessee will have a lease asset and lease liability, and the finance on the lessor will have a lease receivable. If it is an operating lease transaction, the lessor will have an asset and lease revenue, and lessee will have lease expense. So let's look at how we can apply this. So T entered into a non-cancelable 5-year lease agreement with B on 1st of July 2012. The lease is for an item of machinery. At the inception of the lease has a fair value of $369,824. The machinery is expected to have an economic life of 6 years, after which time it will have an expected salvage value of $60,000. There is a bargain purchase option that T Limited will be able to exercise at the end of the 5th year for $80,000. There are to be 5 annual payments of $100,000, the first being 30th June 2013. That is at the end of the first year. Included within that $100,000 lease payment is an amount of $10,000 representing payments to the lessor for the insurance and maintenance of the equipment. So there are the executed costs, and equipment needs to be depreciated on a straight line basis. And it shows that the implicit interest rate could be either 12% or 14%, and we need to determine the implicit interest rate, prepare journal entries for the first year and the second year for lessor and lessee. So to find the implicit interest rate, we take the lease payments, and we take the minimum lease payments, we can discount at 12% and 14%. So we take the discount value for the 5 years, and the annualized discount value is 3.6, and the present value of bargain purchase option is the 80,000 into the discount value at year 5. So we get a value of 369,824. We use 369,824, and then we have the lease payments. The lease payment is 100,000, but executory cost is 10,000. So the actual lease payment is 90,000. And on the outstanding balance, using the effective interest rate method, we calculate the interest expense, and the remainder becomes the principal reduction. So out of the 90,000 for the year ending 30th June 2030, 44,379 is interest expense, and the difference is principal reduction 45,621. The outstanding balance decreases by 45,621 to 324,203. Then there's another lease payment for the year ending 2014, and there's interest expense and principal reduction. And it goes on at the end of year 5, there's a lease payment excluding executed cost of 90,000, and the bargain purchase option that is exercised of 80,000. And the interest expense is 12% of 151,786, 18,214. We take the difference between the total value, which is the principal reduction, 151,786, and there's no outstanding balance thereafter. We can use this information to write our journal entries for the lessee and the lessor. For the lessee, there's a machinery that was acquired asset. We debit and credit, debit lease asset and credit lease liability, 369,824. On that date, for the lessor, there's a lease receivable and machinery that was given to lessee. So we credit machinery and debit lease receivable. The machinery was purchased by the lessor because it's a direct lease, so we credit cash and debit machinery for 369,824. End of the first year, there's cash payment of 100,000 and executory expenses is 10,000. And using the schedule that we have prepared, we break down the 90,000 as interest expense 44,379 and lease liability 45,621. So that's for the lessee. And for the right to use asset, for the asset, we now depreciate this asset. The residual value is 60,000. And the asset is likely to be used for the economic life of the asset rather than the lease period of the asset, because there's a bargain purchase option. So we take the depreciable amount and divide by 6 years, and the lease depreciation expense and accumulated lease depreciation is 51,637. For the next year, there's a cash for that year. The cash received by lessor is 100,000, and we credit executory expenses incurred by the lessor on insurance and those charges. So we credit the expenses 10,000, and for the 90,000, recognize interest revenue and lease receivable based on the interest expense equivalent as interest revenue and lease liability equivalent as lease receivable here. 2014, we look at the schedule, and for the 100,000 that we pay, the executive cost is 10,000, but the interest expense and lease liability is now, their subdivisions have changed because in 2014 year, the depreciation expense is same amount because it's on straight line basis. For the lessor, it is the mirror image of what we have done for lessee. The cash received is 100,000 and reimbursement of executory expenses, and then the interest revenue that is equivalent to interest expense, and lease receivable that's equivalent to lease liability. Let's look at an operating lease. On 1st of July 2012, Margaret Limited enters into a lease agreement with R Limited for the lease of a building. Length of the lease is 3 years, and the terms require annual payments of 60,000. Lease is non-cancellable, and estimated economic life of the building is 20 years. Market value of the building is 2 million. Lease payments are made at end of each financial year. So looking at this, we can see that the lease period is very short. The economic life is 20 years. Length of the lease period is 3 years, and therefore it is less than 75% of lease life. Therefore, we classify that as operating lease. In that situation, for the lessee, we record credit cash and debit rental expense, and for the lessor, we record debit cash and credit rental revenue. Because the lessor is effectively having the asset, although it's been used by the lessee, lessor will depreciate the asset. Depreciation expense 100,000 and accumulated depreciation 100,000 for taking the entire life of the asset, because the lessor is still having the asset, whether there's a lease or otherwise. When there's a manufacturing lease, unlike the direct lease, there's a profit that the manufacturer makes, that is the lessor. So in addition to leasing the asset, there is a gain on the transactions. There's a cost and a sale value, which is the lease value, and there's a gain on the leasing transaction before it is given to the lessor. And that sale value that is to be given to the lessee becomes the fair value of the asset. So based on the information, we can then, just like in a direct lease, we can determine the present value of minimum lease payments, and then do a schedule just like in direct leases, and then come up with the breakdown of the lease principal, repayment, and the interest expense. On a sale and lease back situation, the seller sells the asset to the buyer, and then the buyer becomes a lessor and lease it back to the lessee. Why it is done is in this arrangement, the seller can obtain cash and then get the same asset being leased back to the lessee. So in this situation, the buyer now becomes the lessor and the seller now becomes the lessee. But in the sale of the asset, the seller will make a profit because it's a transaction where the asset has been sold and the buyer has bought the asset. So this situation occurs when a cash is required by the lessee, who's actually was owning the asset, and the sale of the asset and the lease transaction tends to occur simultaneously. Lease back transaction occurs simultaneously. So in that situation, when the asset is being sold, what we have is a cash that is received by the seller, and then debit accumulated depreciation and credit asset, and there's a deferred gain on the sale of the asset. We record the finance lease transaction as before. The finance lease transaction in this situation, the lessor is the buyer and lease asset and lease liability, and then there's periodic repayments by the lessor. The lessee will record the finance lease transaction where lessee will receive the asset, and the lessee is actually the seller of the asset. Will record the lease asset and lease liability, and then just like in a direct lease, we'll record the cash payment, interest expense, and the lease liability. The right to use the asset is also vested with the lessee, who is the seller of the initial seller of the asset, will depreciate the asset and record the depreciation expense and accumulated depreciation. The deferred gain that was earned by the seller, now who's having the leased asset, will now will decrease the deferred gain on a straight line basis. So we credit profit on sale of the lease asset and we debit deferred gain over a period of the lease period. So I'll play a video here. On this video, the number of questions that we have. What is the guidance provided to identify a lease transaction under the revised lease accounting standard? So this is about the new lease accounting standard that is coming into implementation on 1st of January 2019 with early adoption. How and why transaction on intangibles, inventory, and mining and oil transaction come under leasing transactions. If a transaction is considered a lease, does it have to be recognized on a balance sheet? What does each of the five criteria for lease classification as finance lease mean? Title transfer, expected to exercise a purchase option, major part of life, a substantial portion of fair value and specialized value. Make a note of the major part of life which has been removed now from the new leasing standard. Why has 75% of lease as a criterion was removed? So, and then we got other questions. Why was the new criterion, if the asset is so specialized and no alternative use of the lessor at the end of the lease term was included? And why does a lessee calculate the lease liability as present obligation on the expected payment of obligations under the lease? Why does a lessee calculate lease asset as the present value of lease liability and adjusted for amortized initial direct costs and prepaid rent? Why should lessee include renewable options for the lessee, variable lease payments such as index for consumer price index and residual lease guarantees in determining the lease payment? Why is it that when classifying a lease entire payment, including residual lease guarantees, are included in the minimum lease payments? Additional questions are, if the lease contract is just 1 year or less, would it be classified as operating lease? If the lease contract is just 1 year or less but has renewable options that lessee is likely to exercise, would it be classified as an operating lease? If all leases are recognized on the balance sheet, how would the expense recognition differ based on the lease classification as operating lease and finance lease? So make a note that under the new leasing standard, all assets are shown on the balance sheet, but their treatment would be parallel to the old leasing standard, but they would not be off the balance sheet. How would the interest obligation be classified for operating lease? Why is the right to use asset for the operating lease calculated as lease expense minus leasing interest expense that equals amortization? But why is it to be reflected as an operating expense? So I'm going to play the video for you. The additional questions that we have, further additional questions: would the total expense be same as in operating lease and finance lease, regardless of the classification, assuming all else is same? Sale and leaseback items have been applied to real estate and certain equipment, but what would apply to all equipment and all tangible assets with the new leasing standards? Why is it that the key judgment principle in the new leasing standard being whether the underlying asset?
And today we're talking about the new Leases standard from the perspective of a lessee. The most significant impact of the new standard is that lessees will now recognize both a lease liability and a related asset on their balance sheet for virtually all leases. Although the guidance is not effective for public companies and certain other entities until 2019, the standard will require significant implementation efforts between now and then. As a lessee, there are a number of aspects of the new standard you'll want to consider, including what arrangements would be considered leases, whether to classify leases as operating or finance, and finally, how to measure the lease liability, the lease asset, and the associated expense. Let's discuss each of these in a bit more detail. The first step is to identify the population of leases. Similar to today, certain types of assets are specifically excluded from the Leases standard, such as those related to intangibles, inventory, and certain natural resources. A contract not excluded from the scope may be a lease if it provides a customer with the ability to control an asset that's either explicitly or implicitly specified. The framework for determining whether control is provided is consistent with the guidance in the new revenue standard and may require judgment. Although current guidance already requires that companies identify lease arrangements, that determination was not as significant, since operating leases were off balance sheet and there was often no meaningful impact on expense recognition. Under new guidance, however, if an arrangement is a lease or has a lease embedded in it, you'll need to recognize the lease on balance sheet, which makes lease identification more important. Once a lease is identified, you'll need to classify it as either an operating lease or a finance lease. Although this classification does not impact Day 1 recognition, it will impact both the balance sheet and the income statement over the term of the lease. If a lease meets any of 5 criteria specified in the standard, it should be classified as a finance lease because control of the asset is effectively transferred to the lessee. Otherwise, it's an operating lease. The first 4 criteria are similar to the current model, with one notable difference. The FASB removed the 75% and 90% bright lines that exist in current guidance, making the standard more principles-based. The 5th criteria, now included in US GAAP, was previously part of the IFRS model. Is the asset so specialized that it's expected to have no alternative use to the lessor at the end of the lease term? Although this criteria is new, it's not expected to have a significant impact on classification, since a lessor would normally require that it be fully compensated for a leased asset that has no alternative use. Once lease classification is determined, the lessee must measure the lease liability and right-of-use asset. The lease liability is calculated as the present value of the expected payment obligations under the lease. The lease asset equals the lease liability, but is adjusted for certain items, such as prepaid rent or unamortized initial direct costs. Determining the expected payment obligation requires judgment. In addition to identifying the predetermined payments for the non-cancelable portion of the lease, you'll also need to consider other possible payments. Let's discuss 3 common lease provisions and the impact they have. The first are renewal options. Payments for renewal periods are included for any periods when it's reasonably certain that as the lessee, you'll exercise the renewal option. The second are variable payments. If the formula for a variable payment is based on an index or a rate, such as CPI, then the payment would be included in the liability based on the index or rate at commencement. Payments based on usage would be excluded from balance sheet measurement. Last are residual value guarantees. When measuring a lease liability, only the amounts probable of being owed under a residual value guarantee would be included. It's worth noting, however, that when it comes to classifying a lease, a residual value guarantee is treated differently. For classification purposes, the entire potential payment is included in the minimum lease payments. While lessees will generally be required to reflect operating leases on balance sheet, they may elect not to capitalize leases with an accounting lease term of 1 year or less. So if, for example, you have a lease with a stated contract term of 1 year, but you also have 1 or more renewal options, the lease would not qualify for the short-term lease exception if you're reasonably certain to exercise 1 or more of the options. While the new guidance requires that lessees recognize virtually all leases on balance sheet, the expense recognition will differ based on lease classification. A finance lease will be similar to a capital lease today. Interest expense will be recognized based on the outstanding lease obligation using the effective interest rate method. Additionally, you'll amortize the leased asset, often on a straight-line basis. The combination of interest and amortization will typically result in a front-loaded expense recognition pattern. Operating lease expense will typically be recognized on a straight-line basis, similar to how operating leases are accounted for today. However, as a lessee is required to reflect a lease liability and a right-of-use asset on its balance sheet, there's a unique process for amortizing the operating lease liability and asset. Interest expense on the outstanding lease obligation is calculated using the effective interest rate method, So you'll start with the same front-loaded recognition pattern as a finance lease. The lease obligation would be accounted for like other interest-bearing obligations. Cash paid, less interest expense, represents a reduction in the obligation. The right-of-use asset amortization, however, will be a new concept. It's calculated as the difference between the lease expense and the interest expense in the period. In other words, it's a plug. Although the total lease expense for operating leases economically includes both interest and amortization components, it'll be reflected as an operating expense, not as interest or amortization. Notwithstanding the difference in the timing of expense recognition for finance and operating leases, the total expense over the life of a lease is the same regardless of classification. A final area of change relates to sale and leaseback guidance. There are two important points I'd like to highlight. Currently, the most prescriptive sale and leaseback guidance is applied only to real estate and certain equipment, but the new sale and leaseback guidance will apply to all equipment as well as other tangible assets. Second, the new guidance replaces the current highly prescriptive rules with a more principles-based approach that's focused on whether control of the underlying asset has been transferred to the lessor. Judgment will be required to apply many aspects of the standard. Some companies are already starting to think about adoption and transition. Lessees may find that the most significant impact of the new standard will be the effort required to establish robust processes. Those processes will be needed to support the classification and measurement of related assets and liabilities, as well as the significant additional disclosures required. To learn more about the fundamentals and to stay connected with the latest thinking, refer to the lease accounting topic page.
It is transferred back to the lessor.